Buy term and invest the rest is a popular life insurance strategy that's been around for decades, and it's also become one of the biggest life insurance ripoffs you can fall for. And in this video, you're going to learn why this strategy that's become so popular can leave you broke, stressed, and discouraged when you are at your most vulnerable. And I'm going to show you the numbers to prove it. And if being broke, stressed, and discouraged is something you'd like to avoid when it comes to your money, then you need to subscribe to our channel and click that bell so you'll be notified when we publish new videos. Here, you'll learn to build tax-free wealth and financial peace of mind for decades to come. If you've ever looked into life insurance, you no doubt have heard about the buy term and invest the rest strategy. Maybe you've been told that cash value life insurance is a waste of time and money by people like this.
The great ripoff of cash value life insurance is that you will never get both, and you have paid for both. You paid extra for savings, and you have life insurance. If you die, they're going to pay the life insurance, and they keep your savings. If you cash out the savings, they're going to cancel your life insurance.
Dave Ramsey, who has millions of fans and tons of credibility, just said it. The great ripoff of cash value life insurance is that you'll never get both. If you die, you're going to get your life insurance, and they're going to keep your savings. Sorry, Dave, that is simply flat out wrong. It's time you woke up and smelled the new millennium. While some contracts do have that type of feature, these days, the competition over your life insurance premium dollars has led to a much more favorable set of options for you. And those options include contracts, well, they're much better than those Dave is always complaining about. There are contracts where the life insurance you purchase makes up one component of your death benefit and the cash value makes up another. In fact, the type of contract we believe in could actually have as many as 4 components to add to your death benefit. And when you die, your family gets them all. And when it comes to life insurance ripoffs, the buy term and invest the rest strategy is the biggest one of all. But, truth be told, I used to be just like Dave. There was a time when if anyone ever mentioned whole life or cash value insurance to me in the past, I'd be like, grab the torches and pitchforks. Just like Dave, I used to think whole life was a huge waste. And like Dave, I was a big supporter of the buy term and invest the rest strategy. Now, this strategy was created by a guy named Art Williams back in the 70s. He founded a term life insurance company called A.L. Williams that created a movement in the entire life insurance industry. Then he later sold that company, and it became what's now known as Primerica. The story goes that when Art's father died, he had a whole life insurance policy that it paid out something like $15,000. Art felt like 15 grand was hardly enough to replace his father, and a few years later, a cousin of his showed him term insurance. Term insurance back then was hardly ever offered. Well, Art did some math, and he realized that if his dad had purchased $15,000 in term life insurance, he would have saved a bundle, and he could have invested the rest and saved and had more than the $15,000 that was paid out when he died. And so the buy term and invest the rest strategy was born. I'm familiar with the A.L. Williams story because back in the day, I used to be one of his representatives. Have you heard of the buy term invest the rest strategy? Let me know in the comments. So why am I saying that buy term and invest the rest is a ripoff? Why am I saying that it can leave you broke, stressed, and discouraged? Simple. Because if you buy term life insurance, the chances are about 99% that you will never get any tangible benefit from it at all. Just think about it. You have seen the commercials. Bill can buy a $500,000 20-year term life insurance policy for just $30 a month. Just do the math on that. $30 a month over 20 years is $7,200. Now, do you really think that any life insurance company is going to risk a $500,000 for just $7,200? Of course not. If you're offered a term life insurance policy, the insurance company is supremely confident that you are going to outlive the term, and the only payments that would be made in the arrangement between you and that insurance company will be the ones that you make. Now, Does this mean that I don't think you should have any life insurance? Of course not. But what I'm going to show you is the absolute best way to get the most out of paying for the life insurance you know you need, especially when you have a family. Let's look at an example. Let's look at my example. Now, like I said, I used to be a buy term and invest the rest disciple back in the day. When I was 36 years old, I purchased a 20-year term policy with a $500,000 death benefit. My premium, it was just $26.25 a month. Not bad. What that means is over 20 years, I will have paid $6,300, and if I died during that 20 years, my family would get $500,000. Remember that math we just talked about? I mean, do you really think the insurance company was going to put $500,000 on the table for just $6,300 if they had even the slightest inkling that they might have to write a check? Not at all. In fact, here I am, still breathing, totally healthy, and my 20 years are almost up. Then, June 11th, 2018, I got this nice letter from the insurance company informing me of my options as I was just a few years away from my 20-year term coming to an end. Check this out. I was told if you choose to retain your policy after this 20-year period, your premiums will increase as life insurance premiums typically increase as the insured person ages. In year 21, our current estimate of your monthly premium is $569.19. From $26.25 a month to $569.19 a month. So at age 56, I'd have a choice of either losing my $500,000 coverage or paying 21.6 times as much as I paid for the previous 20 years for that same coverage. Or I could pay less and get less insurance. Now, this is the experience millions of people have. And here's the problem with buy term and invest the rest. The problem is that so many people stop at the buy term part. They get that big death benefit for pennies on the dollar, and they put off or eventually completely forget about investing the rest. If I was like most folks and not a best-selling personal finance author and a business owner who has opportunities others simply don't get, when that letter arrived, how do you think I'd feel? I would suddenly realize that maybe I'd let the past nearly 2 decades go by, and instead of investing the rest, I had to use it for all of the life that took place between then and now. And then I'd be forced to decide if I was going to pay through the nose for insurance or face the possibility of dying without it or without enough and leaving my family with little to nothing. What about you? Have you stopped at buying the term? Did you think that by the time your term was up, everything would just have, kind of magically worked out? If you did, you're not alone. And this is why the buy term and invest the rest strategy can leave you broke, stressed, and discouraged. Broke because a new life insurance policy when you're 20 years older is very expensive. Stressed because you'd have to decide to accept those huge monthly premiums or possibly leave your family with nothing. And then discouraged because you would realize that things didn't just work out and you let 20 years slip by and you're back to square one. The ripoff of term life insurance is the fact that the insurance company has all of the numbers on their side, and they are supremely confident they will never have to pay you a dime. That's why it's so cheap. The biggest term life insurance deception is in selling you peace of mind. But that peace of mind is only real if you die before your term is up. Now, do you plan on dying sooner or later? You see what I mean? So you turn 20 years older and you discover you've painted yourself into a discouraging financial corner. Not to mention that a lot of things can happen during that 20-year term. You could get sick and become less healthy. And while you may have guaranteed insurability, which is a rider on many term policies, that rider does not guarantee the cost of the premium. Another deception to term insurance is while the insurance company may guarantee they will insure you after you've outlived your first term, if you're less healthy 20 years later, which, let's face it, that's possible, right? The premium costs will be very expensive and possibly even unaffordable. Now, is that really any way to live? Well, but I hear you. You're thinking, what if you're one of the few who did invest the rest? Some people do, right? What would that look like and what options would you have? Let's look at a 20-year time frame and use that $569.19 I would have to pay to renew my term life insurance 20 years later, and let's take a time machine back 20 years and use that amount to start a buy term and invest the rest strategy. So in this case, the rest would have been $569.19 minus the 26 and a quarter my term insurance premiums would cost, and that would mean I'd have $542.94 a month to put into an investment over 20 years. Let's see what that would look like. Now, there are a couple very important things to point out. The $542.94 a month I would have been able to save would exceed most contribution maximums the IRS would allow for a qualified plan like an IRA. Now, what that means is that the numbers I'm about to show you would be inflated because we're going to view them as if they were tax-free, even though they may not have been. Oh, and before we can calculate the future value, there's a variable our equation must have. That variable is the interest rate I would have realistically been able to expect. Now, if you watch enough Dave Ramsey, you'll hear him talk about how the market can average 12% per year. Just one more thing good old Dave is wrong about. Where do you think he gets that 12% a year anyway? I mean, he's always talking about it, so where does it come from? Well, let me tell you. This goes back to my days when I was one of those buy term and invest the rest guys. Back when I had my license to sell those types of investments and was registered with the SEC and NASD, we were told that when it came to projecting someone's possible future rates of return, the maximum we could use was 12%. The SEC and NASD would not allow us to use a higher percentage. Trust me, if 14% were allowed, what do you think they'd be using to project your future earnings? So the question now becomes, is that 12% Dave and all those investment sales folks, and what they're talking about all the time, is that really realistic? Well, not according to Dalbar Inc. Dalbar Inc. is the financial community's leading independent expert for evaluating customer performance in a number of areas, and one of them is what the actual investor actually earned on their investments. And according to Dalbar Inc., over the past 20 years, the average actual investor earned 5.19% before taxes on their investment portfolio. So using an actual rate of return that the actual average investor can get, that $542.94 a month I would have been investing over the 20 years would have grown to $219,811.06. And that's if I was able to avoid any taxes on the growth. And that's not bad though. I mean, who wouldn't want nearly $250,000? It's certainly better than stopping at just buying the term. During the phase where I'd put my money away, I'd have that $500,000 term life insurance policy. And then in year 21, I'd have no insurance, but I'd have $219,811.06. However, remember, I'm challenging what Dave and many others are saying about whole life or cash value insurance and how it's supposed to be such a ripoff. And I'm actually saying that buy term and invest the rest is a ripoff. I mean, aside from the fact that most people don't invest the rest and wind up painting themselves into a financial corner, how would the right kind of whole life insurance policy have performed? Knowing what I know now, what if I took that $569 a month, the same amount we would have used to buy term and invest the rest, and apply that to the type of life insurance strategy I now have? This type of strategy, by the way, is called a private family bank. What would that look like? Let's take a little peek. If I started putting $569 a month into a private family bank for 20 years ago, by the end of year 20, instead of having to start over, I could stop making any payments at all. I'd have a $495,750 death benefit in year 21 that would continue to grow for the rest of my life without ever having to pay another penny again. And $178,719 of that would be cash value that I could use for anything I'd want. And that $178,000 would also continue to grow for the rest of my life without ever having to pay another penny again. So the death benefit and cash value would continue growing without me ever having to pay another cent. And yes, Dave, that cash value would be mine and not the insurance company's. And instead of turning 57 and being forced to make a decision to pay over 20 times what I paid before, or have absolutely no or less protection in place, I could stop paying and watch my cash value and death benefit continue to grow year after year. Now, while Buy Term and Invest the Rest would provide me with a decent amount of cash, if I spent it all, there'd be nothing left for those I love when I kick the bucket. Contrast that to the private family bank. I could spend almost all the cash value and still leave my family with a ton of money. Oh, and another difference is that the death benefit I would leave behind for my family with a private family bank would be 100% tax-free to them. That may not be the case with the Buy Term and Invest the Rest strategy. I mean, the last thing I want my family to worry about when I'm gone is a visit from the tax man. Here are a couple other very important points you need to know. First, if you do invest the rest in some kind of qualified plan so they're not being taxed while they grow, those funds won't be available to you before age 59 and a half without a penalty or taxes. So if you want to buy a car or help Junior with college tuition, it's not so easy to get to that money. And if you do, you'd most likely be interrupting the money's growth and you'd have less when you need it most. What you'd most likely do is borrow from the bank down the street and wind up, with payments that make them money. The cash value in a private family bank, on the other hand, is available for you to use for any reason at any time while it is simultaneously growing for your future. You can be your own bank, borrow from it, and pay yourself back instead of the bank down the street. And doing that won't have any impact on the performance of those funds. That means the money will be there when you need it most. Another important point is that, you're probably thinking 219 grand is more than 178 grand, right? Well, that 178 grand is totally tax-free. There's something called a tax equivalent yield, and the tax equivalent yield of the $178,000 at, say, 20% is $222,500. Last time I checked, that was more than 219 grand. Now, if you're interested in finding out more about how the private family bank works, you have two options. You can click the link and get your hands on a copy of the ebook, Your Private Family Bank, written by my partner, John Commuta. In it, you'll learn everything you need to know about how the private family bank works and why it's what we believe to be the most powerful personal financial tool for each and every hardworking American. Or you can request a live one-on-one private family bank Q&A call with me, John, or one of our highly trained agents who will answer all of your questions and help you scratch that itch. That itch you have right now in your mind where you're thinking, I wonder how this private family bank thing would work for me. There's no obligation, there's no commitment. I promise you, it's just answers. No matter what you choose, though, you really need to find out how this powerful personal finance strategy can change the course of your financial future. I promise you, you won't regret it. But you may just regret doing nothing at all. Thanks for watching, and I'll see you next time.